Welcome to The Explainer. Today we're unpacking a really fascinating two-sided growth story from First Financial Bancorp. If you've been watching the regional banking sector lately, you know that balancing internal profitability with external expansion, well, it's basically the ultimate tightrope walk. But First Financial just dropped their second quarter 2026 results alongside a major announcement, and it perfectly nails this dual strategy. On one side, we've got record-breaking organic earnings. On the other, a massive strategic acquisition. So let's break down exactly how they're pulling this off, using the data straight from their reports. Here's our quick roadmap for today. We're going to hit the record Q2 earnings breakdown, then move into loans, deposits, and dividends. After that, we'll look at the Finward Bancorp acquisition, how they're expanding their Chicagoland footprint, and wrap up with the transaction terms and future outlook. Okay, Section 1, the record Q2 earnings breakdown. Let's look at their organic growth engine. 80 cents. Now, I know, on its own, that might not sound like a massive number, right? But in the context of First Financial's history, it is absolutely monumental. This 80 cents represents their adjusted earnings per diluted share for the second quarter of 2026. The big takeaway for you here? This is the highest adjusted earnings per share in the company's entire history. It's a huge indicator that their core operations are just firing on all cylinders. To really understand the why behind that record-breaking number, let's hear directly from President and CEO Archie Brown. He pointed out that this record-adjusted net income of $83.9 million was, and I'm quoting here, driven by increases in earning assets from a combination of organic loan growth and our recent acquisitions. I love this because it brilliantly captures the synergy they've built. They aren't just out there buying growth. They're cultivating it from the inside out, weaving in past acquisitions like Westfield and Bank Financial while pushing organic loans forward at the exact same time. Now, what's really interesting to me here is the sheer consistency of their upward momentum. Just looking at the GAAP numbers quarter over quarter, net income climbed from $74.4 million in Q1 to $76.5 million in Q2. The return on average assets ticked up from 1.34% to 1.37%. And the return on average tangible common equity, which is, a super crucial metric of how effectively they're using shareholder money, that rose from 17.78% to 17.95%. It's just solid, step-by-step, quarter-over-quarter improvement across the board. Another huge standout in these financials is their robust net interest margin, sitting at 3.96%, or 3.98% on a fully tax-equivalent basis. Listen, in today's complex interest rate environment, holding a margin right near 4%, that is a massive signal of operational strength. Plus, their adjusted efficiency ratio sits at a really healthy 56.8%. To put that into perspective, it basically means it costs them less than 57 cents to generate a full dollar of revenue. They are doing a fantastic job keeping funding costs managed while making sure their asset yields stay highly productive. Moving right along to Section 2, loans, deposits, and dividends. Let's see exactly how they are sustaining all this momentum. Honestly, it really all comes down to the bread and butter of banking, right? Loans and deposits. End-of-period loan balances jumped by a whopping $240 million compared to the previous quarter. That's a 7.1% annualized growth rate, which was heavily driven by commercial and industrial lending. On the flip side, if we exclude brokered CDs, average deposit balances went up by a very solid $168.6 million. This broad-based momentum tells us their foundation is expanding organically from both sides of the balance sheet. So you might be wondering, why does all this internal growth actually matter to the everyday retail investor? Well, because it translates directly into your pocket. Fueled by this incredible performance, the board of directors actually approved a quarterly dividend increase to 26 cents per share. For sure, this is the ultimate proof of a management team's confidence in their cash flow and capital stability. They are quite literally passing the rewards of this organic growth right back to the shareholders. All right, Section 3, the Finward Bancorp acquisition. This is where we shift to inorganic strategic growth. On the exact same day they announced those record earnings, First Financial dropped a massive headline. They agreed to acquire Munster-based Finward Bancorp, which is the holding company for People's Bank, in an all-stock transaction. Make no mistake, this is not just some minor bolt-on addition. This is a highly strategic, calculated leap to drastically expand their reach. To really grasp the gravity of this move, let's just look at the sheer scale of Finward. First Financial is absorbing roughly $2.0 billion in assets, $1.7 billion in deposits, and $1.5 billion in loans. Not to mention another $412 million in assets under management. That is an absolute mountain of capital, along with a deeply entrenched customer base, being added to the First Financial ecosystem in one single transaction.
Section 4. Expanding the Chicagoland footprints and building a stronger regional franchise.
CEO Archie Brown made the geographic why behind this deal incredibly clear. He stated that adding Finward and People's Bank will strategically expand First Financial's ability to serve the consumers and businesses of the Chicagoland and Northwest Indiana markets. Now remember, they already made some strategic moves in Chicago recently with the Bank Financial acquisition. This new deal essentially supercharges that exact same footprint, targeting an economically robust market with a completely complementary operating philosophy. And the alignment between these two companies is honestly striking. Benjamin Bochnowski, the CEO of People's Bank, perfectly echoed this vibe, noting that together they are creating a stronger regional banking franchise with expanded capabilities, greater resources, and a sharper focus on delivering exceptional service. When both leadership teams share an identical vision for regional dominance and community-centered values like this, integration risk drops significantly. Let's break down exactly how this transforms First Financial's physical footprint. They are instantly adding 24 financial centers that boast a 116-year legacy in Northwest Indiana and Chicago. But check out the most staggering statistic here. With this acquisition, First Financial's pro forma deposits in the Chicago area increased by 75%, pushing them to over $4 billion in that specific market alone. That is a massive leap in market share. But hey, we all know banking isn't just about assets on a spreadsheet, right? It's about the communities you serve. To back up their commitment to this new footprint, First Financial announced a $500,000 donation to their foundation, earmarked specifically for local organizations in the communities served by Finward. This directly mirrors the $1 million they donated when they first entered the Chicago market earlier in the year. It's a very real, tangible investment in the human element of their newly acquired markets. Okay, Section 5, Transaction Terms and the Future. The road to Q4 2026. We can actually simplify these dense transaction terms into an easy checklist. Step 1. Finward shareholders receive 1.35 shares of First Financial stock for each of their shares. Step 2. This values the whole transaction at approximately $208 million. Step 3. The deal is expected to be roughly 5% accretive to First Financial's earnings per share. And finally, Step 4. Subject to regulatory approvals, they expect to close this whole thing out in the fourth quarter of 2026. Now, if you're an investor trying to evaluate the profitability of this deal, you have got to notice the massive green flag in these metrics. The tangible book value dilution at closing is estimated at a mere 0.4%, and the earnback period for that tangible book value just 0.6 years. In the complex world of bank acquisitions, a sub-1-year earnback period with such minimal initial dilution it's practically a unicorn. It's incredibly efficient, which essentially means the deal pays for itself incredibly fast. As we look ahead to that Q4 2026 closing, the integration plan is actually pretty straightforward. Finward's consumer, wealth management, and commercial credit lines are going to be folded directly into First Financial's existing architecture. And crucially, People's Bank employees will officially become First Financial associates. That preserves the local expertise and client relationship continuity that made Finward so attractive in the first place. Which brings us to our final thought for this explainer. We've seen the highest adjusted EPS in the company's history, we've seen undeniably strong organic loan and deposit growth, and now we see a strategically brilliant, highly accretive $208 million acquisition drastically expanding their Chicago presence. So the really provocative question we have to ask is this. How will this newly expanded footprint, combined with their proven organic growth engine, shape First Financial's results in the second half of 2026? If Q2 is any indication, the momentum is entirely in their favor. Thank you so much for joining me today, and definitely keep your eyes on this rapidly growing regional powerhouse.